Okay, recording this video Sunday morning, 6th of January 2013. Well, first of all, an absolutely massive thank you to everybody who sent emails after yesterday's video talking about personal safety and the problems that we had in Paris. Got just a massive number of emails jammed my inbox. I haven't even started to respond to many people, but just to say thank you so much for all the good wishes. They were massively, kind of positive. Great recommendations on self-defense training and some of the kind of psychological aspects of being attacked, plus a huge number of people who'd had a similar experience or kind of could really relate closely to what happened to us and Vanessa. So thank you so much for everybody's good wishes. Vanessa's saying thank you. She's just waving at me while I'm recording this video. So let's get to some charts and to trading. Now I thought, why not do Emini-Watch.com predictions for 2013? Everybody else is, so that might kind of be a useful topic. Put some thought into it over the last few days during some of my downtime, and so here we go. Big drum roll, please. These are my predictions for 2013. I have no idea. Years ago, I used to spend quite a lot of time going through kind of cyclical trading patterns, year by year, seasonality patterns, kind of week by week, month by month, and try and figure out what the market's going to do, what different markets are going to do, and so on. Turning points by month, and so on. And you know what? Over the last 3 or 4 years, I've just found there's just so little value in doing that. A lot of my trading is just incredibly short term. I'm looking at maybe 15 minutes, 30 minutes. I love looking at the big picture. I love trying to get the kind of the macro, understand what's happening in the macro picture. But a lot of these things just you can overthink them, and you can actually kind of get things wrong. You can end up kind of not understanding what's actually happening in the marketplace. So what I promise I will do this year is I will not be stubborn and get caught fighting the trend. Been doing less and less of that in my trading this year, so I've been last year, 2012, been quite happy with that. And I will go with the flow and don't overthink it. As I said, I love trying to understand what's happening in the macro picture, but the market will do what it wants to do, and we need to kind of follow those trends as they kind of develop. So, what I'm using my indicators to do is to try and figure out where those trend moves are breaking out and get on board and play them, rather than trying to have an idea kind of prior to what the market and think what the market should do instead of what the market is actually doing. And in terms of this, don't overthink it. There are correlations correlations are great. They help you kind of understand what's going on with the macro picture and markets moving, and they work until they stop working. We actually, Vanessa and I, had personal experience of that. Vanessa used to work for a hedge fund. It was actually a fund of the fund out of the US, and they had fund managers that were using kind of macro correlations prior to the 2008 kind of global financial crisis, and they'd worked beautifully for years and years. And coming into the financial crisis, they were positioned incorrectly, and those correlations broke. They reversed and went the absolute wrong way. Those funds ended up losing a huge amount of money. And the managers were so stubborn, they kept on saying, after each weekly or bi-weekly kind of performance update call, these things will turn around. They'll turn around. The correlations will kind of re-exert themselves, and the market will do this and do that. And they didn't. They never did. The lesson learned is that correlations work until they stop working, so just be really careful of them. We're in the middle of a correlation at the moment that could be breaking down, the risk on, risk off, and I'll show you some charts to do with that. The other one is the beauty, the US economic growth kind of correlation that we used to have. Do you remember the tech kind of boom where all the money was flowing in when we had huge economic growth, or relatively high economic growth in the US, being driven by the tech boom there? The US dollar was going up because all the money was flowing in to follow the US investment opportunities here. And of course now the US dollar going up is viewed as a risk on trade. So it's kind of money being repatriated from the carry trade and people kind of going to the flight to safety kind of trade. So some of these things just reverse entirely. We've also got kind of historical patterns that could be starting to lose some of their kind of predictive ability. We're seeing diminishing returns coming from the announcement of QE. People are talking about the half-life of QE going down to literally days and weeks when they were kind of months, and coming from those QE announcements. So those are starting to change, and we're in the middle of one at the moment. We will be. We've just dealt with a fiscal cliff, and we've got the debt ceiling debate kind of coming up in the next 6 to 8 weeks that'll start to ramp up, and I just want to show you some charts on that and what happened last time and what's happening this time. So my advice is to look for trend breakouts. Trend breakouts start in the lower time frames. What I'm looking for is breaks of cyclical support and resistance levels using better sine wave, and those start to propagate into higher time frames. And I'm going to show you 2 or 3 charts to show you some of those kind of bigger term trends that are breaking out. I was saying in December that the picture wouldn't become clear until the early part of January, and we're starting to see some of those kind of trends break out on those lower time frames. So let me show you some of those charts. Let's get to some charts. First of all, just talking about this kind of risk on, risk off kind of correlation. We've been seeing strong correlations on the risk off market. So for example, when risk is off, people flow into the safety of the US dollar, US bonds. The carry trade kind of reverses, and we get strength in the US dollar and supposedly strength in the Japanese yen, which is another kind of carry trade. But at the moment, you can see this is a daily chart of the dollar index, what's been happening over the last 6 months or so, and we've bottomed in the US dollar. In the last couple of days here, we've had this really strong breakout move. Now, this is an exhaustion pattern on better momentum, but what's that's showing? It's not on the left shoulder at the end of a move. So, for example, here's an exhaustion pattern at the end of a trend move, and this is a left shoulder being formed. We have pullback to dirty end of trend. We have a bullish divergence and a flush pattern kind of come in, nicely marked. We test back down. Another exhaustion pattern's kind of down here, exhausting the last of those sellers. But we didn't break the lows here. We came very close to it, but all that's doing is flushing out the last of those, flushing out the last of the sellers, and flushing out with large volume of sellers. And now we've got an opportunity to break into an uptrend, and this is the first flush of kind of buying activity. Maybe there's some reversing of positions, kind of short covering kind of going on here, but this is the first break up to a kind of a previous level where we've found resistance, has been support kind of previously, and we're going to try and break through that 81.5 type level over the next few weeks. And this is this initial kind of activity kind of getting us going in this direction. But dollar index is breaking up. Go to the next chart, it's carry trade. So if the dollar index breaking up, and that's kind of a carry trade currency, Japanese yen should be moving the same way. Well, the last 6 months the trade to be on is short Japanese yen. Huge breakdown on the Japanese yen. It's going the other way from the dollar index, where normally as 2 carry trade currencies that would kind of be moving somewhat in sync. And then bonds are going down. So if we've got a flight to safety into the US dollar, they're usually buying kind of treasuries in order to get that safety. And in fact, what we've had over the last several months is a breakdown in the bond market. So we've had our pullback to end of trend. We had a kind of exhaustion patterns going on here, kind of mid last year. All these blue professional bars kind of coming into those highs. Pullback to end of trend being led by the amateurs. You can see all these amateur up bars into a flush pattern. We test back up into a nice Rambo pattern. And this is the first kind of selling move, large selling move, not dissimilar to the bond the dollar index kind of thing that we saw there. This is the initial kind of flush of selling kind of going on. We've gone back up for a weak test, pull back to end of trend. These blue professional bars here and here, a last roll of the dice, that's the professionals getting short, last roll of the dice. And what we've had over the last few days is an initial breakdown of a support level into a trend move on the daily chart, and we've come back down again. Blue professional bars, we kind of got held up a little bit on Friday with the bond market. It did kind of close on the highs there, but that initial kind of move down we maybe have a little bit of strength over a couple of days, but I'm sure this is kind of going through those lows into a downtrend on the dollar index. We're below support, so what I'm saying is you look for these support and resistance levels on the daily charts to be broken after we've had exhaustion patterns. We exhausted on the upside, and now this is the first kind of decent break that we've had of a support line on the way down here. So, dollar index is going up and the bonds are going down. It's like that's a risk on, risk off kind of correlation that we're not used to. That correlation could be breaking down. Let's look at the debt ceiling crisis. The last time we came into the debt ceiling was mid 2011. The deal was done July 31st, 2011. Then a few days later we had S&P kind of downgrade the US bonds, but it was the 2 or 3 months kind of leading into that debt ceiling kind of crisis that I want to look at, and what's going on at the moment and what's going on then. So remember, this is gold on a weekly chart. Coming into that debt crisis, we had strength in gold. We'd had the Arab Spring, and remember, gold always strengthens on political turmoil. So when the politicians are kind of in turmoil, that's when kind of gold starts to rally. So we had a rally because of the Arab Spring. We also had continuing strength in dollar index coming into that because people were uncertain what was going to go on. As soon as the announcement kind of came out and that we were going to continue to fund the debt and create more debt, fears of hyperinflation, continued quantitative easing and so on, rushing into gold, and we had this, it was a massive amount of kind of media speculation. The price of gold went almost $2,000, and that this was because we were going to print our way to the moon, and that's what we had, this blow-off rally in gold, and it actually after 2 months that kind of ceased, and that was the top in gold for the time being. So now what's going on at the moment, the pattern was a strengthening of gold and then an exhaustion of pattern in gold into the last debt ceiling crisis. Well, we're coming into a debt ceiling kind of crisis in the next month or two, and what we've got is weakness in gold. We've had persistent weakness in gold, and we've had a bearish divergence signal after our exhaustion pattern on this weekly chart, and we're inches away from this cyclical support on the weekly chart. We've got no signals that this is going to hold on the weekly chart. If that was going to hold, we'd see blue professional down bars as the professionals are kind of buying into those new lows, and in fact we've had the reverse. We had this blue professional up bar where the professionals were getting short on that retrace move and then desperate to get onto it. As soon as we started breaking back down, they kind of sold that move down as well. So we've got the reverse happening on gold that we had the last time we came into a dollar crisis. Look at the equities market. So the equities market weakened coming into that debt crisis. We were the U.S. politicians were seen to be kind of weak in situation of a crisis, couldn't make a decision. The equity market kind of initially kind of weakened into that. As soon as the announcement was made, we had initial strength, and then the market tanked after that. Well, coming into the crisis, we've had the fiscal crisis over the last couple of weeks, and actually we had equity strength while that kind of debate and melee was kind of going on, and now we're coming into the debt ceiling crisis, and the equity market is strengthening coming into here. So the reverse of what was happening kind of last time. You look at interest rates. So this is the 30-year interest rate chart. So you can look at this. There's obviously no kind of volume data on interest rates, but this on TradeStation is $TYX.X is the symbol for the interest rates, and you can see the interest rates, they're bumped up by a factor of 10. So we're looking at a 3.1 interest rate at the moment, and it just shows there's an index of 31.1 here on this chart. But coming into the last debt crisis, we have rates declining. As soon as the announcement was made and that it was seen that we were going to increase the supply of bonds because the debt ceiling had been raised, interest rates fell more, so there was a greater supply of bonds, so the price of bonds, which is interest rates, kind of went down. So we had this massive collapse. That was a huge move in the bond market and interest rates over the next kind of quarter, you can see here during 2011. So we had weakness and then continued weakness after the last debt ceiling crisis. With this debt ceiling crisis, we've had strength, and it looks like we're breaking into higher rates at the moment. So possibly the good news, the economic kind of good news that seems to be kind of percolating out of the US, maybe the US is going to be one of the stronger economies over the next 12 months. Let's say Europe continues to devolve and fall apart, and we have economic weakness out of Europe. A lot of that, the US looks like a better investment bet than Europe. So we've got fund flows with dollar index rising coming out of Europe and into the US, driving up interest rates in the expectation of higher economic growth potentially. So we've got the reverse happening in interest rates. Then you look at the bonds. Bonds will be the reverse of the interest rates. So we had weakness coming into the rates, so we had strength in bonds, and then continued bond strength when we've seen that we were going to issue more bonds and rates were going to continue to go down. But into this debt ceiling crisis, we've had the reverse. We've had kind of bond market top out, pull back to end of trend with the exhaustion pattern. We've had second cyclical turn after end of trend. Remember, when you get the exhaustion pattern on the end of trend, look for the second cyclical turn after end of trend for that bearish divergence signal to kind of come in. And there we've got that weakness. And in the last week we had an amateur up bar, which shows kind of weakness, and then we've kind of come down pretty strongly this week in bonds. Next one to look at dollar index. So because we had potentially the continuation of printing of money, we had weakness of dollar index, and this was where Peter Schiff was kind of coming. We're going to destroy the dollar, if we keep on, having more and more debt in the system, and so on. And so the expectation was that we were going to get a decline in the dollar and a drop in the dollar. And in fact, we got the reverse. We didn't. We kind of bottomed in the dollar over the next couple of months, and that was the low. That was the low. We have not seen that in a year and a half in the dollar index. And now what we've seen is we've kind of tested back down into these lows. The cyclical support on the weekly chart is held, and we're kind of starting to break back up into this uptrend on the dollar index. So we got weakness, expected weakness in the dollar index coming into that debt crisis, and now we've actually had strength in dollar index for the crisis this time around. So there you go. Just looking back at some of these kind of macro pictures, and some of these correlations kind of fall apart. And my advice is just don't overthink it. Look for trend moves, look for breakouts into trend moves, and kind of ride those either on short term or long term. Now, what I do in my trading on the day trading side, on the E-mini side, is to first look at those lower time frames. Look at the 500 tip bar chart, the 1500, and then the 4500 tip bar chart for those kind of bigger breaks. And what you see is those trend moves percolating through, propagating through from the lowest time frames to the highest time frames. So let's just look at what's going on with a couple of those macro markets, looking at some of the shorter time frame charts into the long time frame charts. So here's the interest rates. This is actually the 10-year. The picture on the rates moves very similar. If you're looking at a 5, 10 or 30-year, the rates in terms of the charts, the values are different, but the charts kind of move in sync, and we've got the clearest picture kind of coming out of the 10-year. If you look at the daily chart here, we had rates kind of last year kind of bottom, pull back to end of trend move here, and we've been moving through a cyclical range. We had another very small little trend move into pull back to end of trend here. Remember, the market moves between trend moves into cycle moves into trend moves. And then we're going through a breakout into another trend move here. So over the last couple of days, we've broken above resistance on daily chart on bonds. So it's the 10-year kind of breaking up to almost 2% here. We're up at 1.9%. If you look at this on the weekly chart, you can see this is the decline that we had into mid this year, pull back to end of trend. The market bottomed. We had a trend move here, went through a little bit of cyclical activity from resistance to support, and now we've got cyclical support coming on the weekly chart using better sine wave here. So this will hold. We've got weeks to run on this, and we've broken into a trend move above resistance on the daily chart. Therefore, that's going to kind of continue up because it's got support in the background from the weekly chart. And you go another time frame up to the monthly chart, same thing. We've got support that played out basically for the last year and a half. We've had support on this monthly chart. That's got a little bit of ways to run before these kind of flip over and cross, and so we're going to see continued support in rates. So I think rates are going up and we're breaking into a trend move. Now the flip side of that will be a break into a downtrend. So if we look, for example, on the daily chart, well, first of all, the weekly chart on bonds, we've had this big move. Middle of last year, we kind of topped out with a pullback to end of trend and an exhaustion pattern. All these blue professional bars coming into that high. We had the test back up. Last roll of the dice, blue professional bar under support here. Another one here, the professionals kind of using that opportunity to get short. We had an amateur up bar testing, and bearish divergence kind of come in It looks like we're heading down. Now, I'm not necessarily saying this is the end for the US bond market, and this is the end of the 30-year uptrend in bonds. Not saying that at all. I'm just saying, look, for the next several weeks, several months, this could be the story in bonds, that we're kind of breaking down into downtrends. And on the daily chart, we've had our pullback to end of trend, flush patterns, and so on. This was the first break, test back up, weak, pullback to end of trend, not a lot of buying going on, and we've broken through support here. So this level is pretty key on the bond market. We might have some strength over the next couple of days because we had professionals kind of come in. We closed near the highs here. We could have a little bit of strength, but remember, we're below support on the daily chart, so we're moving into trend moves down on the bonds. Dollar index, and I've been talking about dollar index for, well, actually about a year and a half. Kind of flipped my trading capital into US dollars out of Aussie dollars. Missed a bit of a run up in the Aussie dollar, has to be said, but I've been quite happy kind of keeping the dollar index, and US dollar looks like it's kind of formed a pretty long-term bottom here. So do I understand why this is going up? Not necessarily, but it could be because people view the US economic picture as being rosier than the Japanese or the Europeans, so for example. But look for the trend moves. So we got weekly support kind of going on here on the daily chart. We've had this exhaustion, flush patterns, bullish divergence, more exhaustion at the same level here. Couldn't break through there, and we're breaking into an uptrend here on the daily chart. We've not got our resistance level kind of printed yet on the daily chart, but when that comes in over the next few days and so on, look for a break of that into a potential uptrend move on the dollar index. And then the flip side of the dollar index is gold. So gold kind of moves counter to dollar index. It's kind of the anti-US dollar kind of currency, gold, if you like. And I've been talking about gold for a while, kind of topping out. And I know the gold bugs I've noticed over the last month and a half, the gold bugs have been blitzing the media in terms of all the stories about gold manipulation, silver manipulation, what the central banks are buying gold now, all the Asians are buying gold and so on. That could well be true, but the chart is the chart. And here we are sitting at a really important weekly support level that printed this week. And in the background, we've got exhaustion buying, this kind of blow-off move into 2000 on gold here, blue professional bars, exhaustion buying, and we tested back into it. We had bearish divergence kind of going on here, and we're at this critical level at a support level on the weekly chart. On the daily chart, we've broken into this downtrend, and several weeks ago, back in November, I was talking about these blue professional bars, and I was saying that's professional selling going on, and to look for lower prices in gold kind of going forward. They freaked out the market a little bit. This was Thanksgiving, and I think everybody remembered kind of the stories around Thanksgiving. Again, the gold bugs were out in force, kind of saying this was a breakout to new highs and so on. But they just professionals just used that little bit of extra lack of activity. There was no one around. They just used that to kind of freak people out, and then these blue professional bars were professionals kind of selling down because now we're below the lows of those blue professional bars. They were using that kind of retrace and this one here in order to get short, and we had these amateur up bars happening here. We're now below support on the daily chart. Yes, we had quite a lot of support, and it was a blue professional bar on Friday. We could find a little bit, it could take us a little bit of time to kind of work through these lows. It was a particular area where we broke out last year into an uptrend. We're coming back down to that level. You can see there exactly where that breakout was. So we might take a little bit of time to kind of get through there. But remember, in the background, we've got exhaustion, bearish divergence, flushing out the last of the buyers, kind of moving into a downtrend because we're below support. So my advice is to look for those support and resistance levels on those lower time frames using better sine wave. Kind of look in the background, make sure that you've got kind of exhaustion volume patterns in the background to show that the buyers or the sellers have exhausted, and we're potentially moving into a trend move in the other direction. And so the chart is the chart. The price activity, the volume activity will kind of show you the way. I love thinking about the macro and I'm trying to understand, how the pieces of the jigsaw kind of go together. But that's not going to stop me, seeing a trend move break out into a trend move. I'd much rather try and understand why a trend move is developing rather than try and anticipate what the market is going to do based on a kind of more fundamental picture of the market. I've got my kind of foibles and views about the bigger picture, but that should not dissuade you from looking at the little short-term trend moves and looking at those kind of breaking out into bigger market kind of trend moves. So there we go. Predictions for 2013. Hope you're enjoying your weekend and looking forward to a decent week's trading next week.